Silver, look at where it sits. It is an extreme bargain at just about $40 an ounce because the high in 1980, inflation adjusted, is $1,640. Bam. That means this is not only a normal bull market, it is also a global monetary system reset. It's vital to grasp that this is not going up. It is mostly currencies depreciating. It is. So for heaven's sake, do not miss it. Hi, this is Mike Maloney with a gold update. First up, this chart here is a couple of months old, but still, gold leads all major assets in 2025. And so we're going to explore some supply-demand here, but I want to show you that correlation economics is showing that retail isn't buying gold and silver. I never make recommendations. I tell people what I do. I don't say buy gold and silver. I just tell you what's happening out there and things you may want to consider. But if you take a look at this, what he's done is he's done a mathematic regression here, and it shows declining sales since 08. It ramped up right after 08, but both gold and silver have been falling in retail sales. And I just, the whole reason I started goldsilver.com and wrote the books and everything is to try and protect people from government stupidity. And I believe, that I have done some of that. I've made a small difference. So we're going to show some of the demand drivers now. China's new physical gold mandate for insurance companies will reshape the world's gold market. So Avery Goodman, and this is also, this is just a few days old, actually. So, a couple of weeks. China's insurance regulator now requires major insurers to allocate 1% of their assets to physical gold, creating unprecedented structural demand. This move is explicitly funded by reducing U.S. Treasury holdings, accelerating China's de-dollarization, and shifting global gold market dynamics. The mandated gold buying at current prices will absorb about 15 to 20% of annual global mine supply. 15 to 20% of annual global mine supply, supporting a significant price increase due to limited new supply. Yes, it would. This percentage will get smaller as price goes up. Given stagnant mine output and rising institutional demand, gold prices are likely to rise significantly above current historic highs in the coming years. Absolutely. If this demand that is mandated, that insurance companies do this, right now it's 15 to 20% at these prices. But this is like an impossible situation. The prices have to rise for that 1% of their yuan-denominated assets to be allocated toward gold. Moving on, Eric Jung, Indian pension funds might invest in gold. And this is from Bloomberg. India's pension regulator is considering easing investment restrictions after portfolio managers pushed for new ways to boost returns on a rapidly growing pool of retirement money. It's not money. This is currency, and they're trying to turn it into money, according to people familiar with the matter. Retirement fund managers met senior officials from the Pension Fund Regulatory and Development Authority in a series of meetings late last month and requested permission to invest in gold ETFs. I wish they would just invest in physical gold, the people said, asking not to be named, and so on. The regulators are considering the proposal and have sent the draft language on gold investments to the funds for feedback. So this is something that is potentially happening, and it's big. Moving on, holy smokes, Eric Jung again, Indonesia looking at reducing gold exports to keep the strategic reserve currency within its own borders. This isn't currency. This is strategic reserve money, and it's the only money they've got a whole bunch of other fiat currencies as reserves. But this is the only money that they hold, but they want to keep it within their own borders. And this, again, is from Bloomberg. So very legitimate stuff. This is old. This was May 27th, but, Florida signed a bill into a law allowing people to make transactions using gold and silver. So gold and silver is being remonetized. I mean, nobody's doing it yet. Do you have to make them at face value on the coins of $1 for a silver eagle and $50 for a gold eagle, which is crazy? Or can you make them at the current spot price? That would be awesome. Here's the Ron DeSantis announcing it. Gold just broke 500,000 yen in Japan. The yen is getting torched, and gold is going vertical. Japan's debt to GDP is the worst in the developed world. Their only option, print or collapse. Either way, gold wins, and that is absolutely true. And gold in Japan has tripled since the beginning of this chart. In just the last 5 years, gold has tripled in Japan. You may have heard Rick Rule say that global allocation to gold has dropped to 0.5% in recent years, while the multi-decade average is 2%. Now, I've heard and seen measurements where gold was actually 8% of global financial assets when it was in a bubble in 1980. So a mere reversion to the mean would quadruple investment demand for gold. A reversion to a bubble like 1980 would be 16 times the investment demand. So the price would have to go astronomical. Well, here's the evidence it may be starting. Hong Kong investors triple gold holdings in rush to save haven, according to Hong Kong Shanghai Bank Corporation. Moving on. Shadowstat's John Williams hasn't updated for a couple of years. Actually, I spoke with John just a couple of weeks ago, and his website broke a couple of years ago, but he does have a newsletter that he emails out to anybody that signs up. So you may want to sign up for that. And so I reverse engineered his data set and its relation to the CPI and filled in the last 2 years. And the results are eye-popping for gold and silver. And I want to once again thank Nick Laird for doing this. He's done such a spectacular job over the years. You may want to go to his website, goldchartsrus.com, and subscribe, help support his work. But here you've got gold with the Shadow Government Statistics alternate CPI, which I want to remind everybody is just the U.S. government CPI. It's their methodology used from World War II until 1982 when they turned the CPI into the CPI, and they've been fiddling with it ever since. Now, I do believe that both government methods are wrong and that the truth lies somewhere in the middle, but the original CPI is much closer to the truth than the new CPI. But this has, you can see that gold is still an extreme bargain, and the Shadow Government Statistics alternate CPI adjusted for inflation, the 1980 high is $35,454 an ounce, excuse me. And if you want to take a look at silver, this is really something. So silver, look at where it sits. It is an extreme bargain at just about $40 an ounce because the high in 1980, inflation adjusted, is $1,640. Bam. So moving on, this is, John sent me these recently. This is the Consumer Price Index. This is the original one, the blue line. This is the CPI starting in 1982, where it diverged from the original CPI. And like I said, the truth lies somewhere in the middle. But when I spoke with John, he believes that gold is just corroborating his assumptions because he was an actuary and his models all stopped working after 1982. And he was trying to figure out why something that had worked for years and years and years just suddenly stopped working. And when he investigated it, it was because the government, the Bureau of Labor Statistics, started fiddling with the way that CPI is calculated. And so he also provides, this has some critical dates. The Federal Reserve, Roosevelt abandoning gold, Nixon closing the gold window, and the CPI reporting alterations started right there. And then he also publishes a much longer term chart, taking it all the way back to the U.S. colonies, the American colonies, not the U.S. didn't exist yet, 1665. And you can see what happened because of that green dot, the Federal Reserve. Something evil has transpired. Eric Young, again, GLD, gold inventory tonnage versus the gold price ratio at its lows. So this is it, and it just shows I don't trust GLD. The price is going up, the tonnage, is sort of flat. That causes the ratio to go down, meaning that the gold price is making new highs while GLD physical gold inventory is hovering at its intermediate lows. Who is sucking physical gold out of GLD? Thanks, Nick Laird, for the wonderful charts. So gold charts are us, or on X, it's goldfish charts. Moving on, gold revaluation, Trump's red button option. And Trump eyes radical gold idea to expose the Fed and anchor the dollar. And this is about issuing gold-backed U.S. Treasury bonds. Forbes talking about the secret weapon Trump can use to take on the Fed, and he keeps on trying to take on the Fed. The logic of auditing America's gold, the measures reintroduced in Congress, is aimed to restoring confidence in a greenback, the value of which has plummeted below 1/3,300th of an ounce of gold. I'm glad that people are starting to finally state this in the proper terms, that the U.S. dollar has been devalued and is now only worth 1/3,300th of an ounce of gold. That it's the dollar falling more than it is gold rising. Now, gold will rise in value during these periods of time when it's basically revaluing itself. This was a lot of the premise of my first book. Jim Rickards wrote a great article, The Truth About Fort Knox and Gold Leasing, that was on Zero Hedge, but it's the end of the article that is important. The gold leasing scheme. There's another even more insidious reason why Trump and Musk backed off from their Fort Knox visit, even allowing for the fact that the gold is actually in Fort Knox. The deeper question is whether that gold is leased. And yes, it is leased. This is I don't have the document in front of me, but I would bet anything they can't do this until the leases have been unwound, but there's big consequences, as you'll see in a moment. The gold leasing is an established market, but not well understood by non-specialists. Even experts in stocks and bonds know little about gold leasing. Basically, it's a way for a gold holder to earn a return. Gold does not pay dividends nor interest like stocks and bonds, but you can lease it to a third party and make 2% or so annually in lease payments. The party leasing the gold does not back up the truck and take it away. The gold stays in the original vault. The gold leasing is purely a paper transaction. The gold lessor gets the lease payment. The lessee gets what's called the right of rehypothecation. That means the lessee can lease gold the same gold to another party, and that party can lease it to a fourth party, and so on. With rehypothecation in play, 1 metric ton of gold could support 100 metric tons of paper gold transactions. At each step in the chain, a party acts like they own the gold for its own purposes of further leases or sales of unallocated gold. Everyone has price exposure and can make money make currency. If the price of gold goes up, in other words, the dollar goes down, or lose currency if the price of gold goes down or the dollar gains a little bit against gold, but that's always temporary. The same principle applies to gold futures, gold options, gold swaps, gold ETFs, and the entire world of gold derivative transactions. The point is that the paper gold world is leveraged about 100 to 1 to the physical gold world, starting with the physical gold in Fort Knox, and I have to add West Point and Denver, because it all depends on how much has been pledged by the U.S. Treasury to the Federal Reserve in the gold notes. The danger is obvious. It's no different than any run on a bank when it comes to bank deposits. If a group of paper gold investors suddenly demands physical delivery, the counterparties will have to buy gold in the spot market since the leased gold is not in their possession. The gold market is liquid, but not liquid enough to support delivery if there were demand for more physical than a small slice of the paper gold market. A full-scale gold panic would quickly emerge. The spot gold price would go to $25,000 per ounce before an investor could yell buy. I take it that someone, possibly Scott Bessent, sat down and potentially explained the paper gold reality to Trump and Musk. Once you understand how the gold market actually works, you quickly back away from putting on a show at Fort Knox. For the masterminds of the paper gold market at J.P. Morgan and Goldman Sachs, the less said about gold, the better. They need to keep the game going, and that's why Trump and Musk won't be showing up at Fort Knox anytime soon. For the rest of us, the solution to this problem is simple: buy gold. So that's what Jim Rickards say. I never advise people to buy gold or silver. I say what I'm doing, and I've bought a lot of gold and silver. I've accumulated, and I don't sell. And so I do believe, though, that Trump wants to go back on a gold standard, but it would require unwinding all of these gold leases first, and to unwind those gold leases, shrink right now, if 1 metric ton can support 100 metric tons, and this is like a maximum, I think, that Jim is estimating here. It probably isn't 100, but if the entire paper gold world, I ate an avocado a little while ago, is leveraged about 101 to the physical gold world, that means that the entire gold market is hallucinating that there is 100 times more gold out there than really exists. And that means the price is suppressed from where it would naturally be trading if they were trading real gold. But they're not. They're trading hallucinations. And so I said that the Treasury isn't leasing this gold. It's central bank gold leasing, which is a proven market. It absolutely exists. And here's where our gold is. If you go to the Federal Reserve, this is federalreserve.gov, and you go to their H.4.1 release of Federal Reserve balance sheets, factors affecting reserve balances. You scroll down to the very bottom, and the very last table in here is collateral held against Federal Reserve notes. And so this is currency in circulation. It's the $20 bills in your wallet. And here is the gold certificate account, $11,037,000,000, and at the statutory price of $42.222222 out into infinity dollars per ounce. $11,037,000,000, I believe, is 99.7% of all of America's gold, which is your gold and my gold. It's not their gold. This was nationalized by Roosevelt, illegally, basically, violating Article 1, Section 10 of the Constitution of the United States, which is a treasonous act to do that, and nationalizing America's gold. When somebody uses the word confiscation, they're usually using it as a scare tactic to get you to buy something that's overpriced. So moving on. What happened to the Fort Knox? This is Chris Martinson. I love Chris, friend of mine. What happened to the Fort Knox audit? It was canceled due to lack of resources. If the gold belongs to somebody else, then yes, there is a lack of resources. And then there will be no bubble phase in this gold market. And this is entirely possible. So Grady, or however you say your name, I'm not sure, Grady, he could be absolutely right. Because this time around, after the present third final bull move, the world will have a new monetary system backed by gold. Boy, I sure hope not. A monetary system backed by gold is a gold standard. And I mean, I've said many times, gold is great. Gold standards suck. What we need to do is get rid of the words dollar, yuan, yen, pound, euro. We need to get rid of those words and replace them with grams, nanograms. That's the word, that's what we should be using. If the world used gold instead of these hocus pocus the gold standards open the door for the scam to start all over again, this fractional reserve scam. So anyway, this will pin gold at the highs value-wise, meaning there is no bubble. It'll pin gold at the highs price-wise. But if the dollar still exists, they'll continue printing more dollars than it'll be connected to gold somehow. But it's always a fractional reserve scheme. Jim Rickards believes that it should be a 40% reserve ratio. Well, that's where we were when the Federal Reserve started. But then we went on to the Bretton Woods system with no reserve ratio. And that means this is not only a normal bull market, it is also a global monetary system reset. It's vital to grasp that this is not going up. It is mostly currencies depreciating. It is. So for heaven's sake, do not miss it. And I agree with him. I don't recommend anybody buy gold, but that's what I'm doing. Gold and silver. And I let the gold-silver ratio dictate which I buy. But he shows this 2,400% move back in the 70s, and then these second bull move, third bull move, and so he's considering this one big bull market. And it's a proper way to consider this because, since Nixon took us off of gold and took the world off of gold when he ended the Bretton Woods system, but actually this was two bull markets punctuated with a cyclical correction in the middle. And this is actually one bull market punctuated with this cyclical correction. This is one bull market, but it's punctuated with a cyclical correction. So this is really the proper way to draw it, probably. But I want you to notice that this chart is logarithmic. 50 to 200 is a factor of 4 times. 200 to 800, the same distance, is a factor of 4 times. Well, you go 4 times the current price for the same amount of distance, and you're up at about 12,000, and 4 times that. So this price target that he's got on this chart is somewhere like $50,000. Now, is it going there? Entirely possible. If it is, does it make any sense to keep the word dollar around if the dollar devalues at that type of speed and pace? And so the proper way to use gold is if this is a monetary reset, and I believe it is, hopefully the public doesn't get scammed again and we go back to just pricing things in gold. And I want to show you something here that's already happening in Venezuela. A friend sent this from El Dorado, Venezuela. He goes into a supermarket where everything is priced in grams of gold. Historically, real money will win out over government abuse. Watch how they pay in gold. And this is extremely interesting. He goes around and shows that everything is priced in grams of gold. And I'm going to skip forward. These are grams of gold. That's 0.06 grams of gold. Everything. And I worked out the price on this. He shows some Bailey's Irish Cream and that price is about $44 a bottle. And then he shows how they pay with these little flecks of gold. And so these aren't in fungible increments. So they're going back to sort of like a barter system. And then at the very end, he goes to the cash register and he's paying in gold on a scale. And she weighs it and logs it all in and stamps these receipts. And they've just paid in real gold. Now, it would be best if that gold was see, this is gold ore. It's just a fleck, not ore, but refined gold that's a fleck. If you mint it into a coin of equal weights, you've got money. You can digitize that money, that's fine. But if it's just payment in gold, then gold will win and the public will not be getting scammed. I want to thank you for watching. We'll see you next time.
Invest and earn up to $2,000 in bonus silver at goldsilver.com. It's easy. Step 1. Open any gold-silver storage account excluding IRAs. Step 2. Purchase your precious metals. Step 3. Get up to $2,000 in bonus silver dropped straight into your vault. Visit goldsilver.com/free silver to claim your silver.